Hey everyone, thanks for checking into Stock Investing and Trading 101. We finally reached 200 subscribers, and to show appreciation to everyone, I'm going to be giving away a free iPod Touch to one lucky subscriber. To be entered in the raffle to win, all you have to do is subscribe to the channel and comment below why you think you should be the winner. Today's topic for the video is going to be the Iron Condor Option Strategy. Essentially what this is typically a position that you receive a credit when you open, and you receive your profit, maximum profit, when the underlying security trades within a certain range. Typically this is a market neutral strategy, so pretty much you're looking for the security to stay flat for the most part, not make any big moves up or down. And the Iron Condor position is constructed of two credit spreads. If you're unsure what a credit spread is, I'll have a link in the description to a video I made discussing how to open credit spreads and what they are. Essentially what a credit spread is you are buying and selling one option, either calls or puts. Once you use a call, you have to make both of them calls or both of them puts. You can't have one call and one put in a credit spread. So for an example of a call credit spread, we would be buying the $35.50 call and selling the more in the money and the more expensive $35 call. So let's say the $35.50 call was worth $10, so we bought this for $10, and then the $35 call that we sold, which is worth more because it's more in the money, let's say this is worth $12. So we bought this for $10, we sold this for $12, we would receive a net credit of $2 there. And the same goes for puts. So for this Iron Condor, we're going to be opening a credit spread using the calls like I just mentioned, and we're also going to be opening it using puts. So for this example, we would be buying the $34 put and selling the more expensive, more in the money $34.50 put. So for both of these, essentially this is just two credit spreads mixed into one position. So for this one position, using the two credit spreads, we would receive a net credit opening this position. In this case, when we opened this position, we would receive a 34-cent credit, or $34 in cash. You do this by timesing the credit times 100, and that is your maximum profit potential. So in this case, your maximum profit received from this Iron Condor is $34. And the way you receive this maximum profit is if the underlying security trades within the two shorted options, which is the two options that you've sold. So in this case, if AT&T trades between $34.50 and $35, we would receive our maximum profit. Once again, that range is the two options that you sold. So you should have sold one call and one put, and there is a difference of 50 cents here, but that is the range. So as you see on this chart, our maximum profit is this line up here, this blue line, the flat blue line, and we receive our maximum profit if the strike price is between $34.50 and the $35 here, which is a pretty tight range, but if it trades in between there, we would receive our max profit. Also, the stock can go a little bit further or down and you would still be able to make a profit. So let's say it went to 35.10, just slightly above 35. You would still receive a profit, however it wouldn't be a maximum profit. The way you can lose on this Iron Condor position is if your calls or puts go in the money. So essentially the strike price or the stock price would have to go either above or below your where you purchased at. So for this example, if the stock went above 35.50, which is about right here, we would receive our maximum loss. And if the stock went below $34, which is about right here, we would receive our maximum loss as well. So you don't want either one of these option spreads to go into the money. You want them both to be out of the money, and that is the whole point of the Iron Condor. To calculate your maximum loss potential, all you have to do is find the width between the calls and the puts. So for this example, the width is 50 cents between each of them. So because we have 35 and 35 and a half. One thing to note is that your width between the calls and the puts should be the same. You shouldn't have a 50-cent width between the calls and then a big $1 split between the puts. That will skew the whole profit risk profile. So you want to have a even range. If it's a $1 range, you want it to be $1 on both of them. If it's 50 cents, you want it to be 50 cents on both of them, and so on. So for this example, our maximum loss, we have a range of 50 cents. You times that by 100 and get $50, and then you minus the credit received. So the credit received is $34. You take 50 minus 34, and that gives you a maximum loss potential of $16 for this position. So the most you can lose is $16, and the most you can make is $34 for this position. This always changes depending on the width, of course, and which security you're using it on, but that is how you calculate it. Essentially, the credit received is max profit, and to calculate max loss, just find the width in the strikes and minus the credit received. One thing to note is, as I said, this is generally a market neutral strategy, but you can slightly skew this to make it slightly bullish or bearish, as well as widen the range. I'll show you an example. So for this example, we've already went over the maximum profit and the maximum loss. We've already went over the price range needed to make money, more or less. And we've also discussed where the most you can lose is. So if the stock price goes below the 34 or above the 35 and a half, that's our maximum loss. But as saying, if we wanted to make this somewhat bearish, let's say we thought AT&T was going to go just a little bit down and then kind of stay flat, we could adjust either the calls or the puts. For this example, we're going to say we're bearish. We think the stock is going to go down, and we are going to be generally a little bit bearish. So we could widen our range like this, and this would make it so that, first of all, our maximum profit would only be $28 for this position because that's our credit. So we gave up some potential profit when we widened our spread. But we also have now the stock could trade all the way between about 34 and 34 and a half now for us to make maximum profit. Also, you can do this on the bullish side. So let's say you thought it was going to go up a little bit. You could just do the same thing, but instead you would just adjust your calls to be more on the caller side. So that is how you can open a Iron Condor position. You can widen the spread. You could even make this wider if you want, but you're going to be giving up potential profit. The wider it is, the less profit you have. You can either buy or sell Iron Condors. Typically, I always open them receiving a credit, so you would be selling the position. If you open the position, the risk profile completely changes, and I don't want to overcomplicate this video because option strategies can be somewhat confusing. So essentially, I just wanted to teach you guys the basics. Essentially, the Iron Condor is used when you think a security is going to remain relatively flat and you want to collect the premium on that security. Essentially, what you're doing is just collecting time decay. You're selling options and you're collecting the theta decay on those positions. So that's the video. I hope you guys learned something today. If you have any questions or comments, definitely feel free to ask. I will be announcing the winner to the giveaway at the end of the month. Please subscribe to my channel, check out my other videos, and we'll talk to you guys soon.